Good morning, friends. Let's now continue. Let's now start with your FM revision. I'm going to first talk about the subject in general as to what are the areas which are there, what is important, what is not so important from exam point of view. If you look at the paper, 60 marks is dedicated to FM, 40 marks is dedicated to economics. I think you're already done with your economics revision. Now coming to FM, it is broadly split into 10 chapters. But this 10 can also be reorganized as maximum 6 or 7 chapters. It's not that there are 10 chapters. Your chapter 4, 5, 6 is a single cluster. It used to be a single chapter called as financing decision earlier. Now they have made it into multiple chapters. But so this is a single chapter. So you have chapter 4, 5, 6 which is a single cluster. Chapter 1 and 2 is technically also a single cluster which is purely theory based. You have purely theory based area which is your chapter 1 and 2. I have not covered it as part of my material also in the revision because it's purely theory based. From your exam point of view, what happens in costing as well as financial management is the theory question can purely be an optional question. So what happens is there are 4 questions of 5 marks each which is mandatory for you to attend, which is a 20-mark question. Then you have 5 questions of 10 marks each. There will be 5 questions of 10 marks each and you are required to answer 4 out of 5 in exam. So 20 marks of mandatory question and then 4 out of 5, 10 mark questions. So technically you are required to answer for 60 marks, and if you are well prepared, you would be in a position to answer entire 60 marks of practical problem. In case you are struggling with some question, then theory will come as a in that rare scenario where you are not confident, theory is going to come as a savior for you. Otherwise, theory is something which we normally don't expect you to attend as far as FM is concerned. The same thing I had told you in costing also. So 1 and 2 is one chapter which is single cluster. 4, 5, 6 is again a single cluster. So you have 2 clusters. 7 and 8 again becomes a one cluster. Both are on capital budgeting. One is from return point of view, second is from risk point of view. So broadly speaking, we have 1 ratio analysis, 2 financing decision, 3 investment decision, 4 dividend decision and 5 working capital management. Totally 5 areas are only there from a problem solving point of view, and these 5 areas are basically the role of CFO. If you would have gone through the different decision a CFO takes, he has to take investment decision, he has to take financing decision, he has to take dividend decision, and for doing dividend decision he has to do some financial analysis. So these are your chapters. Working capital is basically a hybrid decision which is there. Today I am going to start with a very simple area which is on leverages. Leverages on financing decision side. Now why I am starting with leverages? One, it's quicker, easier to complete, and also every exam I am seeing one question coming from leverages. So it is the simplest of the lot, but still every exam we are seeing questions coming from leverages. So come to page 73. Computation of or your format for calculation of leverages. Now let's first listen for some time and then we start solving problems. When it comes to leverages, there are 3 types of leverages. One is your operating leverage, second is your financial leverage, third is your combined leverage. What leverage basically says is the reward which an organization gets, the reward comes in the form of profit after tax or earnings per share. The reward which an organization gets is going to be disproportionate to the efforts taken. What is disproportionate to the efforts taken is sales. Sales is my effort. The end result of that is profit after tax or earnings per share. Sales has doubled. My understanding, profit should also double. But when sales double, profit will become 5 times of this earlier profit. Profit, instead of doubling, it will become 5 times, 4 times, 3 times. When sales come down by 50%, profit may come down by 100% also or 150% also. So what you may think that if sales is going up by 10%, profit should ideally go up by 10%. That's a normal understanding. But the reward which an organization gets is going to be disproportionate to the efforts taken. This disproportionate thing comes because of 2 reasons. One, if you have fixed cost in your capital structure, or second if you have fixed capital, sorry, fixed cost in your cost structure or fixed capital in your capital structure. What is fixed capital? Is preference capital and debenture, because for that you have to pay a fixed preference dividend and fixed interest needs to be paid irrespective of what an organization earns. Whether organization is earning profits, not profits, you are required to pay interest and preference dividend. Similarly, you are required to incur fixed cost irrespective of whether turnover is happening or not. So broadly, three types of leverages. Operating leverage occurs because there is fixed cost, there is fixed cost in the cost structure of the company. Financial leverage occurs because there is a fixed capital which leads to interest and preference dividend, and combined leverage is a combination of these two, which is OL into FL. Go through this part, go through the format and the formula. Go through the format and formula. Okay, your operating leverage is going to measure how much is the EBIT going to change with the change in sales. If sales go up by 10%, EBIT may go up by 20%. It can be even double of that. That change is measured through operating leverage. The formula for that is contribution by EBIT or percentage change in EBIT by percentage change in sales. The second approach which we have is which is your financial leverage, which is going to measure how much is going to be the impact on EPS. What is going to be the change in EPS for a percentage change in EBIT. So the formula for that is EBIT divided by earnings before tax. The difference is the preference dividend, difference is the interest, minus preference dividend divided by 1 minus tax rate, or percentage change in EPS by percentage change in EBIT. If you look at what distinguishes or what differentiates of contribution in EBIT is fixed cost. Contribution minus fixed cost is EBIT. Operating leverage occurs because you have fixed cost. Operating leverage occurs because we have fixed cost. Financial leverage occurs because we have interest and preference dividend. And the differentiator is this: EBIT to EBT, the gap is interest, and from there you have to subtract the preference dividend. Combined leverage is multiplication of these two. Let's start with problems. Let's come to question number 1. X Limited has estimated that for a new product its break-even point is 20,000 if the item is sold for 14 per unit and variable cost is 9. Calculate the degree of operating leverage for sales volume of 25,000 and 30,000 units. So the requirement was simple. You have to just calculate the operating leverage. Your wish, whether you want to solve problems along with me or listen, your wish. Wherever it is critical, I'll tell you to make notes, but otherwise it's up to you. How do you want to do it? That's something you can manage. Now the question says, it is going to break even at 20,000 units if the item is sold for 14 per unit and variable cost is 9 per unit. I am required to calculate degree of operating leverage, which is technically operating leverage. I am required to calculate operating leverage. How do I calculate fixed cost in this case? How do we calculate fixed cost? Marginal costing. How do you calculate fixed cost here?
The break-even units into contribution.
Yeah, break-even point is equal to fixed cost by contribution per unit. Break-even point is equal to fixed cost by contribution per unit. Fixed cost is something which I'm going to calculate. My break-even point is 20,000 equal to fixed cost by 14 minus 9. Fixed cost turns out to be 1 lakh. Fixed cost turns out to be 1 lakh. Your fixed cost by contribution per unit is the formula for break-even point. So break-even point is 20,000 is equal to FC by 14 minus 9 into 5 you end up getting 1 lakh as fixed cost. The fixed cost figure is 1 lakh rupees. Computation of leverages. Friends, now it should be fine. Computation of leverages. Computation of leverages. We are required to calculate the operating leverage. Operating leverage for 25,000 units and 30,000 units. The requirement is to calculate for 25,000 units and 30,000 units. So particulars 25,000 units, 30,000 units. The formula for operating leverage is contribution by EBIT. So I need to get to the contribution number, contribution by EBIT. Contribution by EBIT. So sales less variable cost, contribution less fixed cost, EBIT. Sales less variable cost, contribution less fixed cost, and EBIT. The selling price is how much? 14. So 25,000 into 14, 30,000 into 14. Variable cost is 9 rupees per unit. Variable cost is 9 per unit. So 25,000 into 9, 30,000 into 9. You get contribution. Fixed cost we have calculated, which is 1 lakh. And you get EBIT. 25,000 and 50,000. EBIT is 25,000 and 50,000. My operating leverages, contribution divided by EBIT. Contribution divided by EBIT. 5 times and 3 times. Contribution divided by EBIT 5 and 3. 5 times and 3 times. Now, what does operating leverage indicate is, it is going to measure how much is going to be the change in EBIT for a percentage change in sales. For example, when I started with 25,000 units, 3,50,000 is the sales. Sales of 3,50,000 is going up to 4,20,000. If you look at the percentage, it's a 20% increase. It's a 20% increase. 3,50,000 going up to 4,20,000 is technically a 20% increase in sales. If sales is going up by 20%, EBIT will go up by 20% into 5. Sales is going up by 20%. EBIT will go up by 20% into 5, which is 100%. EBIT would have doubled. From 25,000, EBIT has doubled to 50,000. When sales went up only by 20%, EBIT has doubled in this case. 25,000 has become 50,000. Clear? Let's look at question 2. There's nothing much to do here. It's a quick discussion. Following summarizes the percentage change in operating income, percentage change in revenue, and betas for 4 pharmaceutical company. Change in revenue, change in operating income, and beta. Calculate the degree of operating leverage for each of these firms. Comment also. Use the operating leverage to explain why these firms have different beta. See, beta is something you would have learned when we would have done your financing decision cost of equity calculation. Beta basically indicates how risky a company is. High beta means high risk, less beta means low risk. Here, change in revenue is given. Change in operating income is nothing but EBIT. The term operating income is EBIT. So my operating leverage is equal to percentage change in EBIT by percentage change in sales. Percentage change in EBIT by percentage change in sales. The data is almost available, nothing much to calculate. Now, if you have a very high operating leverage, you are considered to be a risky company. Reason for that is high operating leverage means even sales go down by 1-2%, profits can go down by a very high number. Go up, it can go up by a very high number. So it's a volatile kind of a company. If you have an operating leverage of 5 times, if sales in the previous example had come down by 20%, EBIT would have gone down by 100%. So it would have become 0 EBIT there in the previous question. So having a high operating leverage can be linked with high beta. So 0.9 to find lowest beta, 1.28, then 1.15. So your beta and operating leverage can be linked together. Beta and operating leverage can be linked together. High operating leverage leads to high beta. So when operating leverage is lowest, beta is minimum at 1 time, and when operating leverage is maximum, beta is highest at 1.40 times, because your beta also measures the risk. Operating leverage also indirectly tells the risk of a company. Go through question 3. Okay, this is a comprehensive question where they've given the capital structure details, then the cost structure details. They want us to calculate what is the change in EPS, calculate financial leverage, operating leverage when the sales is 2 lakh units and 2,40,000 units. So let's do this. Working note 1, income statement. Income statement at 2 lakh and 2,40,000 units. 2 lakh and 2,40,000 units. Particulars 2 lakh units, 2,40,000 units. Two lakh and 2,40,000 units. We have a format to calculate all leverages. Starting with sales, you go until EBIT, deduct interest, EBT, deduct tax, EAT, deduct preference dividend, EAES, number of shares, and EPS. EAS, number of shares, and EPS. Starting with sales till EPS, till earnings per share. Starting with sales and going on till earnings per share. So sales is 2 lakh units, the selling price is 10 per unit. The selling price is 10 per unit. 2 lakh into 10, 2,40,000 into 10. Variable cost is 6. Contribution 8 lakh and 9 lakh 60. Fixed cost is 4 lakh. So normal income statement, I don't have anything tricky to explain here. Interest is 10% debentures of 20 lakh rupees. 2 lakh. Tax rate is 50%. No data on, I think, preference part of it. $20,000 shares are there, and we get the EPS 5 rupees and 9 rupees. This income statement I really don't want to explain much. Let me know if there's a doubt here. Any doubts on the income statement? It's a straightforward income statement which we need to prepare. We follow the format, and the format guides us to the income statement. Any doubts on this? Now, questions requirement were, what is the percentage increase in earnings per share? From 5 rupees it has gone up to 9 rupees, which is a 4 rupee increase or an 80% increase. It's a 80% increase. Also, they want us to calculate OL and FL, operating leverage and financial leverage. OL, FL. Operating leverage formula is contribution by EBIT. FL formula is EBIT by EBT. There is no preference dividend in this question. So, my operating leverage is contribution of 8 lakh by EBIT of 4 lakh, 2 times and 1.71 times. This is EBIT by EBT, 2 and 1.56, 2 times and 1.71 times, 2 times and 1.56 times. Question somewhere has asked, comment on the behavior in relation to increase in production. See, earlier we were selling 2 lakh units. At that time, the OL and FL were 2 times. That is, if sales go up or come down, the EBIT can double change, and from that EPS can further double change. That is what has happened in this case. Your sales has changed by 20%. Your EPS has changed by 80%. That 80 is nothing but 20% into 2 into 2. Your OL into FL is the combined leverage. OL into FL is the combined leverage. So, indirectly, if sales changes by 1%, earlier the profits were changing by 4%. Now, that has come down. The reason for that coming down is simple. Earlier, I was at a lower volume. Now, I have become a bigger company. When I become a bigger company, a change from there will not impact me that much. So, earlier when I was a smaller company, even a small change was impacting my profit significantly. Now, when I become a bigger company, the risk is coming down. The risk is coming down, and that is being reflected in OL and FL coming down. When production increase, your both have come down, which signifies a reduction in the risk for the company. There's a reduction in business risk as well as the financial risk. Business risk is measured through operating leverage. Financial risk is measured through financial leverage. Go through question 4. Okay, an income statement has been given. We are required to calculate OL, FL and CL, and then there is some change in sales. They want us to find the new earnings per share. So, they have given an income statement. I don't want the income statement in this format. My format is slightly different. So, I will put the income statement in the format which helps us in getting the leverages. So for getting the data of leverages, we'll have to follow this format. So I start with sales, which is given in the question. Sales is 3,40,000. Your operating cost is 1,20,000, which includes a depreciation of 60,000. Depreciation is a fixed cost. Depreciation is a fixed cost, so minus 60,000. Fixed cost is 60,000. I get EBIT. Interest is given, which is again 60,000. EBT is 1,60,000. Tax is 56,000. EAT is 1,04,000. No preference dividend. EA is 1,04,000. Number of shares are 8 lakh by 10, 80,000. And I get a EPS of 1.3. I get a EPS of 1.3. Once this is done, OL is contribution by EBIT. FL is EBIT by EBT minus preference dividend, but that part is not there. So OL is 1.27. Automatically it's a formula driven area, so I don't want to spend much time there. FL is 1.38 times, and my CL is contribution divided by EBT. Contribution divided by EBT, your combined leverage or operating leverage into financial leverage. If you want to do that multiplication, then you should calculate 4 decimals for OL and FL. Otherwise, rounding off issues will happen. Your combined leverage is 1.75 times. Combined leverage is 1.75. This is not the important part of the question. This is just a formality. This is just a formality which I have completed. I have calculated all the leverages. After that, the question is saying, if the total assets remain at the same level, but sales increase by 20%, decrease by 20%, what will be the EPS at the new sales level? So they want us to find what is going to be the new earnings per share when the sales go up and come down, when there is an increase in sales and when there is a decrease in sales. They want us to find out what is going to be the new earnings per share. Which leverage combines sales change and EPS change? Combined leverage. So combined leverage, listen, this links percentage change in EPS and percentage change in sales. Question has asked sales is changing and they wanted us to find the EPS. Your financial leverage, percentage change in EPS and percentage change in EBIT, and your operating leverage links percentage change in EBIT and percentage change in sales. So question has said sales changes and they wanted the EPS. The question sometimes could have said the sales changes, but they wanted you to calculate the earnings before interest and taxes or earnings per share. They could have asked any of that. Now here the requirement of the question was sales is changing and they want us to find the EPS. They want us to find the EPS. Sales change is equal to 20%. Combined leverage is equal to 1.75. EPS change is equal to 1.75 into 20, 35%. EPS change is going to be 35%. If the question had asked for new EBIT, not the EPS, then I would have used the operating leverage. So different leverages link different items. The question could have said the EBIT is changing, find the EPS. Then I would have to use financial leverage. So old EPS 1.3, new EPS is 1.3 plus 35% and 1.3 minus 35%. One time sales is going up, another time sales is coming down. When sales go up, EPS will go up by 35%. When sales come down, EPS will come down by 35%. Very simple calculation. You have the old EPS that will either go up by 35% or come down by 35%. Go through 5. Okay, there are two parts to the question. In the first part, they have given sales, they have given variable cost. Sales is 90 lakh, variable cost is 54 lakh. You get your contribution, you have your fixed cost, you get the EBIT, you subtract interest, you do everything and get to the EPS. I'm not going to talk about the first part of the question. I'm going to talk about the first part of the question. When I come to the second part of the question, they are saying what should be the level of EBIT if EPS is 4, 2 and 0. The existing EPS, let me just give me a minute. Okay, existing is 3.71. Okay. If it was, I will prepare this income statement again. I will keep it till this only. The income statement from EBIT till EPS, from EBIT till EPS, from EBIT till EPS. They wanted EPS of 4, EPS of 2 and EPS of 0. These are the three levels given in the question, and we are going to reverse work and get to the EBIT number. We are going to reverse work and get to the EBIT number. EPS is 4, 2 and 0. The number of shares in this case is 4 lakhs. So you reverse work and get to the earnings available to equity shareholders. 16 lakhs, 8 lakh and 0. I don't think so, preference is there, so 0. EAT, tax rate given in the question is, sorry, okay, 30% is the tax, so this is 100, tax is 30 and this is 70, 100, 30 and 70. Your earnings before tax is 100, tax is 30%, earnings after tax is 70. So I am doing grossing up of this. So this should be my EBT. This should be my EBT. Tax is 30% of this. Tax is 30% of this. Interest in this case is, you have 12% debentures of 40 lakhs, so 4 lakh 80, and reverse working we get to know my EBIT should be this much. The question's requirement was to calculate what is the likely EBIT if EPS is 4, 2 and 0. Clear? Any doubts on this? Let's go through 6. It's more of a discussion thing. Go through 6. No major calculation to be done. Okay, from the following information has been extracted. They have given sales PV ratio using the concept of leverage. Find out and verify. I'm going to discuss only about the verification part of it. Finding out is something you can do it later. You'll have to prepare an income statement, do it. Percentage change in taxable income if sales increase by 15%. What do you mean by taxable income? How much? Sorry, what is that? No, I don't think so. That's EBIT, because look at the last question. Percentage change in taxable income if EBIT increased by 15%. EBT, it should be earnings before tax. So they want us to find percentage change in EBT if sales is changing by 15%. Can you think and tell me sales and EBT? Sales and EBT is linked with which leverage? Combined leverage. EBT is basically EAT. EAT is basically earnings available to equity shareholders. So whatever is the percentage change in earnings per share, the same percentage change is going to happen in EBT. The combined leverage is 1.4 into 1.25. Can you do this? 1.4 into 1.25. So the percentage change in taxable income if sales increase by 15% is equal to 15 into 1.75. Percentage change in taxable income is equal to 15 into 1.75. Which leverage links EBIT and sales? Operating leverage. So operating leverage is 1.4. This is 10%. So percentage change in EBIT is equal to 10 into 1.4, 14%. 10 into 1.4, 14%. Which leverage links EBT and EBIT? Financial leverage. This is 15%, so 15 into 1.25. 15 into 1. This is one part of it. This is the verification part of it. First, you will have to do the calculation of it. So you will have to do the calculation and then show the verification. So this 26.25 is what we have calculated using the logic of the leverage. Then you have to prepare this statement and show that 26.25 is exactly happening that way. Similarly, here the 14% is exactly happening that way. And similarly here I think the change is 18.75. Clear? Any doubts on this? Question 7, I'm not doing it. It's a slightly tricky question. It will take us some more extra time. So I'm not doing it, but you can get back to me if there are doubts. I've explained it in a simple manner, so you can solve it. Later on, if there are doubts, you can get back to me. I'm not discussing it as part of the class. Go through question 8. Go through 8. Okay, now onwards what you are going to see is the reverse working kind of a problem. What is reverse working is they'll give you some leverages, some missing information would be there, and based on that missing information somewhere using the leverages understanding, if we prepare an income statement, the question has not asked for an income statement, but most of the times you will be required to prepare an income statement. The question wants us to calculate financial leverage and PV ratio. For PV ratio somewhere indirectly the income statement would be needed. So I'm going to do an income statement. The income statement will broadly give me the solution to this answer. So let's start. We have a format of income statement. It starts with sales and goes on till EA, ES and EPS. Some question your income statement may have to stop at earnings before tax. Some question it may have to stop at earnings before tax. That depends whether we have data on tax rate in the question. Some question data on tax rates will not be there. If data on tax rates is not available, you may have to stop it at EBT. If data is available, you go on till earnings available to equity shareholder and go on till EPS. Let's look at this. Combined leverage is 2.5, so I'm filling whatever is available. Combined is 2.5. Your operating is 1.25, which indirectly means this is 2 times. Your financial leverage is 2 times. OL into FL is CL. So your financial leverage indirectly has become 2 times. Given that equity dividend is per share is ₹2, interest is 1 lakh. So I know interest is 1 lakh. This is an information available. Fixed cost is 50,000. Fixed cost is 50,000. Sales is 10 lakh. Sales is 10 lakh. So sales is 10 lakh, fixed cost is 50,000, interest is 1 lakh. These are the 3 terms we have. Sales is 10 lakh, fixed cost is 50,000 and interest is 1 lakh. I don't have anything else in the question. I don't see tax rate data being there in the question. So I'm not going to try to go beyond this, okay. I will stop my calculation at this. I don't think so I'll be able to move beyond this. I'll not be able to move beyond this. So I'm going to try to restrict my analysis at EBT level. I can assume a tax rate and close it also if I want. I can assume some tax rates and prepare the income statement. The requirement was not to prepare an income statement. Now, OL is there. OL is contribution by EBIT. If you have a leverage and if you have one of the two, contribution or EBIT, or the item which is in between them. See, if you have the operating leverage and you have either contribution or EBIT or the item which is in between, you can calculate all the three. Basically, contribution, fixed cost, EBIT, everything can get calculated, assuming you have one of them. If you have either contribution or fixed cost or EBIT, if you have one of these three items, it is possible for you to calculate the balance. So, OL is equal to contribution by EBIT. OL which we have is 1.25, contribution is X, EBIT is X minus 50,000, EBIT is X minus 50,000, EBIT is X minus 50,000, your fixed cost was 50,000, this will give me the answer to contribution, So, 1.25x minus 62,500 is equal to X. X finally I think will be 2,50,000. X is 2,50,000, which is your contribution. So, contribution is 2,50,000. EBIT is now 2 lakhs. EBT is 1 lakh. Variable cost balancing figure is 7,50,000 and PV ratio is contribution by sales. They have asked for PV ratio, which is contribution by sales. Anything EB, you will get the same thing. Here then contribution should be X plus 50,000. It is X, if EBIT is X, contribution is X plus 50,000. I will check the calculation later. 9 I am not doing it, it is a fairly simple question. Go through 10. Go through question 10. Okay, this is a problem where multiple concepts are tested. They have asked for multiple items. I don't see tax data there in the question, so I'm going to stop my income statement at EBT. I'm going to stop my income statement at that level. I can proceed forward also if I assume a tax rate. You can assume a tax rate and proceed forward as well. So, sales is 75 lakhs. Variable cost is 42 lakhs. Contribution is 33. Fixed cost is 6 lakhs. EBIT 27. This is interest is 4,05,000. EBT is 22,95,000. My operating leverage is contribution by EBIT 1.22 times. This is EBIT by EBT and combined leverage is contribution by EBT. I am not discussing much on the leverage part. These are formality. Nothing much is there. Questions requirement, return on investment, ROI. What is firm's return on investment? ROI or ROCE, these are the two alternative names. You could have learnt about this in ratio analysis. So, ROI is equal to EBIT by capital employed. EBIT by capital employed. Return on investment is equal to EBIT by capital employed, or you can say EBIT into 1 minus tax rate by capital employed. There's a pre-tax ROI and there's a post-tax ROI. So which is 27 lakhs. 27 lakhs by 45 plus 55. Capital employed is debt plus equity. Debt plus equity, which is 45 plus 55 into 100. So this is 27%. Your return, this is called pre-tax ROI. This is called pre-tax ROI. We also have a post-tax ROI. There are two types of return on investment: pre-tax ROI and post-tax ROI. Pre-tax is 27%. Post-tax we cannot calculate because tax rates are not there. Does it have a favorable financial leverage? Financial leverage are of two types. One is favorable, second is unfavorable. A firm has favorable financial leverage if ROI is greater than cost of debt. If return on investment which the company earns is 27%, cost of debt is only 9%. Company is paying 9% interest, but on that capital it's earning 27% because capital also includes the debt. So you are earning 27%, whereas you are paying only 9%. That is a favorable financial leverage. Sometimes you may be earning only 5%, but you have to pay interest of 9%. That's an unfavorable financial leverage. So does it have a favorable financial leverage? Yes, it does have a favorable financial leverage. If the firm belongs to an industry whose capital turnover is 3, does it have high or low capital turnover? So capital turnover formula is sales by capital employed. Sales by, we have some multiple turnover formula. Asset turnover is sales by assets. Working capital turnover is sales by working capital. Fixed asset turnover is sales by fixed asset. Similarly, capital turnover is sales by capital employed. Capital employed is debt plus equity. Debt plus equity. So the capital turnover here is 75 lakhs by 1 crore. 75 lakhs by 1 crore, which is 0.75 times. The industry is at 3. So we have a low capital turnover. We have a low capital turnover as compared to the industry. Different leverages we have calculated. I'm not going to do all this 4 parts, but I want to discuss few things. Sales drop to 50 lakh. What will be the new EBIT? 2 options. You prepare another statement. Sales and EBIT is linked with which leverage? Sales and EBIT. Operating. So what you can do is, sales has dropped to 50 lakh. There is a percentage change in sales you can calculate. You know the operating leverage. Percentage change in EBIT is percentage change in sales into the operating leverage. Something like this. Okay. Earlier sales 75 lakhs, new sales 50 lakh, decreases 33%. Operating leverage is so much, so the percentage fall in EBIT will be this, and you get the new EBIT. To avoid rounding off issues, I've calculated so many decimals, else there can be a huge rounding off issue which can happen. This 16 lakh is also possible for you to calculate if you prepare an income statement like this, because sales from 75 lakh has come down to 50 lakh. Sales has come down, your variable cost will also proportionately come down, and your EBIT is 16 lakhs. EBIT is 16 lakhs. This is an easier part to do, but in exam the expectation is you will interpret and do. You will interpret the leverages. Next is, if the sales is increased by 10%, what will be the EBIT increase? Which leverage links sales and EBIT? Operating. So you multiply and then calculate. At what level of sales EBIT will be equal to 0? First tell me, EBIT and sales is linked with which leverage? EBIT and sales. Combined leverage. So what I can say indirectly is, EBIT is coming down by 100%. EBIT is coming down by 100% because EBIT is becoming 0. So sales should come down by what number? Sales should come down by what percentage? Normally sales will be given and you calculate the EBIT change. Here the EBIT is going to change by 100% because EBIT is technically becoming 0. So EBIT changes 100%. The combined leverage which we have is 1.44. So I can say 100 by 1.44. Sales should change by 69.55%. Technically you may work with 4 or 5 decimals to avoid rounding off differences. If sales fall by this percentage, EBIT will technically become 0. If EBIT increases by 20%, by what percentage EBIT will increase? EBIT and EBIT which leverage? Financial leverage. So you will have to be very careful about which are the leverages linking them. Go through 11. Go through 11. Vishnu, 5 minutes lower. Okay, I need to prepare an income statement. Income statement questions, when asked in exam, high probability, it's a missing information question because some of the data points would not have been given in the question. We have some leverages. So the rule is simple. If you have operating leverage in the question and you need either contribution or fixed cost or EBIT, one of the three you have, you will be able to calculate the balance. If you have financial leverage in the question, then you either need EBIT or interest or EBT. One of the three you have, you will be able to calculate the balance. Let's put the format first. Our format will start with sales. I think tax rate is also there in this question. EBT less interest, EAT. EBT less interest and EAT. Simple rule, will fill whatever is available. Once you do that, you will be able to get to the balance information. Company A, company B. Sales till EAT, starting with sales till EAT. I have some data points in the question. Variable cost is 56,000. Fixed cost is 20,000. Interest is 12,000. 9,000. Tax rate is there and sales is there. Sales is 1,05,000. Variable cost is 60%. Contribution is 42,000. So this is the information available in the question. The leverages which I have is financial leverage. The formula for financial leverage is EBIT by EBT, assuming preference dividend is not there. If you have either EBIT or interest or EBT, you will be able to calculate everything. So I use financial leverage of company A. FL is equal to EBIT by EBT. The FL given is 5 times. So 5 times is equal to, if I go to my income statement, I take EBIT as X. EBT will be X minus 12,000. I'll solve this, I'll able to get what is X. X will turn out to be 15,000. So that gives me my EBIT number, and balance part will be a formality. More or less, I'll get to the balance part, which is, this is 15,000. EBT is 3,000. Tax rate is 30%. EAT is 2,100. Contribution is a balancing figure, which is 15 minus of minus 20, 35,000, and my sales is reverse working. 35,000 minus of minus 56, 91,000. So I got sales as 91, variable cost was given, contribution is 35,000, fixed cost we had calculated, EBIT is 15,000, interest is 12, and EBT. The other scenario they have given OL. OL is contribution divided by EBIT. That makes it more simpler. Contribution is already there. 42,000 divided by EBIT is 4 times. So my EBIT is indirectly 42,000 by 4. My EBIT is indirectly 42,000 by 4. Fixed cost, EBT, this is sorry, less tax and EAT. Clear? Any doubts on this? Any doubts on this part? Question 12. Okay, you do this. You start doing question 12. Okay, this is a straightforward, simple question. Nothing much for me to discuss except for the last item, which is called earning yield. That's the only area I just wanted to discuss. When you do earning yield, what is the formula for earning yield? EPS by market price per share. The formula for earning yield is earnings per share by market price per share. So that's the formula you'll have to use. Balance is more or less a straight formality. EPS by MPS would give you this answer. 13 is okay, that's kind of a homework. You can kind of manage it. 100. Okay, I'll come to question 14. This is also slightly different kind of a question. Let's discuss 14. The capital structure of JCPL Limited is as follows. Guys. Capital structure of JCPL Limited is as follows. Equity share. Guys. You have any doubts, you discuss with me. I don't want any cross discussion, please. Any doubts you can ask to me. I don't want any cross discussion. Equity share capital 8% preference share, 10% debenture. This is a question where preference capital is also there. I want to discuss this question. Also some more other information is there. Additional information, profit after tax is 1,82,000, operating expense 1.5, equity share dividend paid 15%, market. One is operating and financial leverage, which is what we normally do, but this question also has preference dividend. So good question to practice. Preference dividend coverage and earnings dividend coverage. This is learnt in ratio analysis, but I'll discuss it here. Earnings yield and price earning ratio. Again, learnt in ratio analysis, we're going to discuss here. And net fund flow. Let's first prepare an income statement. This question also has preference dividend and all. Everything is there in this question, including preference dividend. Starting with sales, less variable cost, contribution, less fixed cost, EBIT, less interest, EBT, less tax, EAT, less preference dividend, EAES, number of shares, EPS, operating leverage, financial leverage. This question, my financial leverage can't be EBIT by EBT. It has to be EBIT divided by EBT minus preference dividend divided by 1 minus tax rate and combined leverage. Let's fill whatever we have. Profit after tax is 1,82,000. Profit after tax is 1,82,000. I take tax as 100, sorry, EBT as 100, tax is 30, EAT is 70. Operating expense including depreciation of 90,000 is 1.5 times of EBIT. I'll park it for the time being because I don't know the EBIT number. I'll calculate this later. Equity share dividend paid is 15%. That's the dividends actually paid by the company. Again, not using it for the time being. Market price is 20. This market price, equity share dividend and all will help me in calculating this price earning ratio, earning yield, all that information can be calculated. I can now reverse work and say 1,82,000 by 70%. EBT is 2,60,000. Tax is 78,000. Interest is 10% debenture of 100 each, 4 lakh. So this is 40,000. EBIT is 3 lakh. My operating expenses was 1.5 times of 3 lakh, which is 4,50,000. 1.5 times of 3 lakh, which is 4,50,000. In that 4,50,000, depreciation is 90,000, which is fixed, and variable cost is 360, 7,50,000. Preference dividend is also there in this question. Preference dividend is 8% into 6,25,000, which is 50,000. EAES, number of shares are 80,000. EPS is 1.65. EPS is 1.65. Now, operating leverage is very simple, which is contribution by EBIT 1.3. I just want to do financial leverage calculation properly. FL is equal to EBIT by EBT minus preference dividend divided by 1 minus tax rate. The reason is why we are dividing 1 minus tax rate is EBIT is before tax, EBT is also before tax. So preference dividend has to be grossed up. Preference dividend is an item which is deducted after tax, after you get your earnings after tax. So EBIT is 3 lakh, EBT is 2 lakh 60, preference dividend is 50,000 divided by 1 minus 0.3, which is 0.7 times. 1 minus 0.3 is 0.7. So 3 lakh, 2 lakh 60 minus 50,000 divided by 0.7. How much you get denominator? 188,571, and you finally end up getting the financial leverage, which is 1 point. Okay, so that's your financial leverage, operating leverage and financial leverage. This question has preference dividend. Other questions till now did not have preference dividend. Cover for the preference dividend, equity share of dividend. Cover for the preference dividend is, this is a coverage ratio. How you calculate coverage ratios? Preference dividend coverage. Any coverage ratio is from where are we paying that money divided by what are we paying. For example, preference dividend is paid out of EAT of the company. Preference dividend is paid out of the EAT. So PD coverage is equal to, I am going to pay it out of the EAT and I am paying preference dividend. You can calculate, the calculation is not the important part. Preference dividend coverage ratio is, what are you paying is the denominator. From where are you paying it? You are paying it out of the earnings after tax. Equity dividend coverage is equal to, what are you paying is equity dividend. From where are you paying is EAES. EAES by equity dividend. From where are we paying? Equity dividends would be paid out of the earnings available to equity shareholder. Denominator, what are you paying is the equity dividend. Earnings yield is EPS by MPS, and P multiple is MPS by EPS. P multiple is price by earning. The name itself will say price earning multiple. So the formula is price divided by earning. Price by earning, MPS divided by EPS, price earning multiple, and this side it is EPS by MPS. Net fund flow is nothing but PAT, add back depreciation, which is a non-cash item, and subtract the two dividends which you are paying, because in the profit after tax the dividends would not have been subtracted. PAT plus depreciation and subtract the two dividends, preference dividend and equity dividend. Go through question 15, a quick discussion on this. Go through this. Net fund flow is basically the cash flow which the company gets. So the net cash inflow to the company is profit after tax, add back depreciation because it's a non-cash item, and subtract the two dividends which you are paying because that's a money outflow. Go through 15th question. Okay, not much for us to solve in this question. They have given two scenarios where the fixed cost can either be 5,000 or 10,000, and your borrowings can be either 10,000 or 30,000. Borrowing is going to change your interest expenditure. There can be a problem where they can give you three different level of fixed costs and three different level of interest expense also. This is only 2 and 2. So I need to calculate operating leverage and combined leverage. I don't know whether the fixed cost is 5,000 or 10,000. So two scenarios. One is 5,000 fixed cost. Second scenario, fixed cost is 10,000. Similarly, the interest expenditure can either be 1,000 rupees or 3,000 rupees. So put together it's 2 into 2, 4 scenarios. If a question has 3 different fixed costs, and 3 different interests. It's 3 into 3, 9 different scenario. It's not 3 plus 3, it's 3 into 3, 9 different scenario. Format remains the same. Fixed cost of 5,000 plus interest of 1,000. Fixed cost of 5,000 plus interest of 3,000. Fixed cost of 10,000 plus interest of 1,000. Fixed cost of 10,000 plus interest of 3,000. You add them together and then try to calculate it. I just want to discuss one, I think the additional question which is there, which is a recent question. Go through question 9, page 192. Additional question. Question 9, page 192. Please go through this. Okay, I'll discuss this question and start solving it also. There is one tricky part which you'll face when you start solving it. Company P and Q are having the same earnings before tax. Margin of safety of company P is 0.20. Margin of safety is you go back to an area in your marginal costing. For company Q, it's 1.25 times than that of company P. This is 0.20, this is 1.25 times higher. Interest expense is 1,50,000. Company Q is 1/3 less. Financial leverage is 4 and this is some 75% less. PVR is given, tax rate is given. You are required to prepare income statement. Let's try preparing an income statement. We'll struggle at some place. Particulars, company P and company Q. Company P and company Q. Sales less variable cost, contribution less fixed cost, EBIT less interest, EBT less tax and EAT. There will be few challenges in this question. It's not a straightforward, direct kind of a question. EBIT? No, I'll come to it. So this is a format. Both the companies have same earnings before tax. I don't know that number. Margin of safety is 0.20 for company P. Company Q is 0.25. Company P is 0.20, 1.25 times. There's a use of this margin of safety. That is where the tricky part came. The interest expenses, company P is 1,50,000. Company Q is 1/3 less than that of company P. Company Q is 1/3 less. So this is 1 lakh, 1/3 less. Financial leverage is company P is 4 times. Financial leverage of company P is 4 times. And Q is 75% of company P. Q is 75%, which is 3 times. Can you get me EBIT and EBT quickly? Get EBIT and EBT quickly. 4 times and 3 times. You have interest expense, so you will be in a position to calculate EBT and EBIT. EBT and EBIT would be possible for you to calculate. One is X, other one is X minus 150. Use the financial leverage and get EBIT. Use the financial leverage. EBIT is X, EBT is X minus 150. So X divided by X minus 150 is 4 times. You will get an answer to X, which is going to be 2 lakh. For the other scenario, it's going to be 1 lakh 50. Other scenario, it's going to be 1 lakh 50. Okay. Beyond this is where the difficult part of the question comes in. Tax rate is 45%. EAT, all this is perfectly fine. I don't have a problem with this. I don't have any problem with this part of the calculation. I don't know the contribution because question has not given me the information on contribution. I also don't have information on fixed cost. I don't have information on fixed cost. What we have been normally doing is, if you have either contribution or fixed cost or EBIT, you'll be able to calculate the balance too, provided question gives you operating leverage. Question gives you operating leverage because you use the formula for operating leverage and then get to the solution. The problem is this question has not given operating leverage in a direct manner, they have given in an indirect manner. And this is a formula which I have not touched upon till now, even in my regular classes. I have not done this formula. This is a formula which they have given. This is a good right interpretation. There is a margin of safety given in the question. What margin of safety indirectly mean is, margin of safety is 20% of sales, which indirectly mean my break even point is 80% of sale. My break even point is 80% of sale. So margin of safety 20%, break even point 80%. Break even point is linked with an item called as fixed cost. Break even point is linked with an item called as fixed cost. Margin of safety is going to be linked with an item called as EBIT in this question. Normally it's linked with profit. Normally it's linked with profit. Here it's linked with EBIT. Together is your contribution. EBIT plus fixed cost is together called as contribution. Now, whenever margin of safety is given in the question, you can say operating leverage is equal to 1 by margin of safety. Operating leverage is equal to 1 by margin of safety. Wait for a minute. Operating leverage is equal to 1 by margin of safety. If I take first example, what is the margin of safety for the first company? So operating leverage is 5 times. Operating leverage is 5 times. Listen. Now what this means is, contribution is going to be 5. Okay. Just for an imaginary sake. Okay. Contribution is 5. Or let me take 50,000. Okay. Contribution is 50,000. Fixed cost is 40,000. EBIT is 10,000. I have the exact numbers. I can calculate it in some time, but let's understand the concept. 50,000 by 10,000 is your operating leverage of 5 times. This is break even sales. This is margin of safety. Margin of safety is 10,000 on a base of 50,000. Margin of safety is 10,000 on a base of 50,000 because margin of safety will give me the EBIT. Margin of safety into PVR will give me EBIT. Normally it gives profit. Okay. Normally it gives profit, but in this the context of this question it will give you EBIT. Break even sales into PVR will give you fixed cost, and total sales into PVR will give you contribution. So if your margin of safety is 0.20, your fixed cost or your break even sales is 0.80. So the link between these two items, Margin of safety is indirectly 1 by 4 of break even sale. Margin of safety is indirectly 1/4 of your break even sales, or 1/5 of the total sales. 1/5 of the total sales. So what you can do is, once you do a reciprocal of margin of safety, that ratio, you get operating leverage. That's the only formula I wanted to touch upon, because balance is simple. Once I tell you operating leverage, you will calculate contribution, you will calculate sales, everything will be a formality. The important part is inverse of margin of safety. Inverse of margin of safety is your operating leverage. This is a detailed explanation. MOS is 20%, break even sales is 80% of sales. Therefore, I can say fixed cost is 80% of contribution. EBIT is basically 20% of contribution, and this is the interpretation. Contribution by EBIT, 1 by 20% is equal to 5 times. In short, it's inverse of margin of safeties. This is an explanation for you. I don't need you to present this in exam. In short, operating leverage has a new formula which I did not touch upon till now, and that is inverse of margin of safety. That is your inverse of margin of safety. Balance is formality beyond that. Once you use that, you will get your contribution. Using that, you will get your sales. All that is okay. The important thing is inverse of margin of safety. You will have to use inverse of margin of safety to get to the operating leverage. Operating leverage is equal to 1 by margin of safety. This formula was not there in any of the ICA material till now. This is a right formula. The formula is right, but we have never used in any of the question. So this question has that, so that's why I have discussed this. Inverse of margin of safety will become, this is I think May 2022 RTP question. Inverse of margin of safety will become your operating leverage. Clear? Any doubts on this? Balance, your additional questions are fairly simple. That's not an issue. Okay. So I'm kind of done with your discussion on leverages chapter. In the leverages side, I think this should broadly be okay. We have kind of covered almost all the question except for one or two question which I have left it. That is something which you can manage. It's a fairly simple area, format driven area. It's purely a format driven area. Go through ratio analysis. Multiple formulae will be there. Go through that.
We are supposed to take asset details, so can we stand in one corner and just count?
Yeah.
Thank you.
Please go through the various ratios formulae. Please, when I start solving question, then you will struggle. Please start going through the formulae. Go through the formulae. Guys, the time is given for you to go through this, please. Okay, there are multiple category of ratios there. There are three types of questions which will come in exam. One, they'll ask you to calculate ratios. Second, you may have to reverse work with the ratios and prepare a balance sheet or an income statement. So they may ask you even a trading P&L or only a P&L or only a balance sheet also. So that's the second type of a question. The third type of a question is where they'll tell you to do some interpretation, where you will are required to compare your ratios with the industry averages and give some commentary on the company's performance. When it comes to ratios, we have multiple category of ratios. So you may have some 35-40 kind of a formula, but different categories have different, there is a general theme for every formula. For example, the first is liquidity ratio, in which the basic two questions which will come mostly in exam is current ratio and liquid ratio. Current ratio and quick ratio are the most two important problems. Current ratio is current assets by current liability. Quick ratio is quick assets by current liability. In quick assets, from current assets, I'm going to subtract stock and prepaid expenses. The other ratio I'm not discussing much because that's not that critical. Second is on capital structure. What is capital structure? Is the term capital means long-term money, which is the composition of debt, equity and preference in a company. Composition of debt, equity and preference in a company, or how you are funding your asset side of it. There is a liability side, and how are you funding that? There is asset side of it, multiple assets are there. How are you funding that is also done. The first is debt ratio, which is total debt by capital employed. Capital employed is debt plus equity plus preference. In the debt, sometimes you can even include preference capital. In a practical world, the term preference can either form part of debt or can it form part of equity depending on the characteristic. So debt ratio is total debt by capital employed. Equity ratio is total equity by capital employed. Debt to equity ratio is total debt by total equity. The term debt can be interpreted as total debt, can also be sometimes said as long-term debt. Sometimes it can even be said as outside liability. What is outside liabilities? Even creditors will be included in that. Your other current liabilities will be included in that. So all anything other than equity will form part of total outside liability. Debt to total assets ratio is again debt by assets. This is one important. These two are important ratios here. Capital gearing ratio and proprietary ratio. What is capital gearing ratio is fixed charge bearing capital by shareholders fund. What is fixed charge bearing capital is fixed capital. What is fixed capital is debenture and preference capital. Debenture and preference will form part of fixed capital. Denominator is your shareholders equity. Proprietary ratio is proprietors funds by total assets. Proprietary fund is owners funds. How much is the owner funding the balance sheet of the company or funding the assets of the company. Coverage ratio, I'm not discussing the formula. The rule is simple. Coverage ratio is what are you paying is the denominator, from where are you paying is the numerator. Interest coverage ratio, interest is paid out of the EBIT of the company. Interest is paid out of the EBIT. Debt service coverage ratio, debt services, interest and installment, they are paid out of the profits of the company. They are paid out of the profits of the company. So what are you paying is the denominator, from where are you paying is the numerator. Activity ratio or efficiency ratio or turnover ratio. For turnover ratio, your numerator will mostly be sales. Your numerator will mostly be sales. Denominator will be whatever is the item they are saying, except for few ratios. One is stock turnover ratio, where the numerator is COGS. Where the numerator is COGS. For example, total asset turnover ratio, the numerator is sales by total asset. But sometimes if you don't have sales, you can use COGS as a proxy. That or is the proxy, that's the second preference. But for inventory turnover ratio, COGS is the first preference and sales is the second preference. Sales is the second preference. Debtors turnover ratio, we will use credit sales. We will use credit sales rather than the sales. Payables turnover ratio, we will use credit purchases. Now, whatever turnover ratio you calculate, that is described in times. You will say inventory turnover ratio is 5 times, debtors turnover ratio is 10 times. This can be calculated as inventory days, debtor days, creditor days. For that, you have to do 360 or 365 divided by the turnover ratio. 360 or 365 by the turnover ratio. And one more rule is, if any ratio, if you have one item from income, one item from P&L, and another item from balance sheet, if at all any ratio, one item comes from P&L, another item comes from balance sheet, the balance sheet item has to be the average. The balance sheet item has to be the average wherever possible. For example, you see here, credit sales by average accounts receivable, average debtors. If I have data, I'll have to take average of debtors. All this also you have to take average, okay? Average fixed assets, average total assets if you have data. If you have data, you have to take average, else you take the for the year period and close it. These items I'm not going to take any average, okay, because this is both the items from P&L. If both items are from P&L or both items are from balance sheet, current assets by current liability, you're not going to take any average there, because both items come from the balance sheet. One item from balance sheet, one item from P&L, you need to take the average for the balance sheet item. This is related to profitability ratios. The denominator is going to be sales. The numerator can keep changing: gross profit, net profit, pre-tax profit, operating profit, COGS. So whatever is that ratio, the name of the ratio will tell the formula. Again, no averaging here, no concept of averaging, because both comes from P&L. Return on investment ratios, ROI or ROC, which I had discussed in one of the question. EBIT by capital employed or EBIT into 1 minus tax. The rule is you have to take average capital employed if you have. If you have average data, you have to take average capital employed. Return on equity is what goes to the equity shareholder, which is EAES. Finally, the equity shareholder will get that. Divide by equity shareholders fund. Again, average if possible. Again, average if possible. Return on assets, net profit after tax by average total assets. See, some of the formula I would have used the word average. Some of the formula I wouldn't have used the word average. Rule is very simple. If you have one item from P&L, another item from balance sheet, please take an average of the balance sheet item. Earnings per share, dividend payout ratio, all these are self-explanatory. Apart from this, I think there's one more item called as your return on equity calculation as per DuPont model. I'll come to the DuPont model when I do a problem. Let's start with question 1. Following information and ratios are related to a company: sales for the year, GP ratio, fixed asset turnover ratio based on COGS, stock turnover based on COGS, liquid ratio, current ratio, debtors collection period, reserves and surplus, capital gearing ratio, fixed asset to net worth. You are required to prepare a balance sheet. Nothing much for you to go through. I'm going to focus on few questions. I'll do the detailed balance sheet. Few questions I'll give you indicator that what items could be there, and based on that, how do you go about preparing your balance sheet or income statement. Let's look at this balance sheet we need to do. So I write the format and leave it, okay. Balance sheet, liabilities amount, assets amount. I'll just write the format and then leave it here. I don't have any of the numbers, may not be there. Okay, liabilities amount, assets amount. Now let's look at what you can do. Any question, if you have this combination, liquid ratio and current ratio, if you have this combination in a question, you can use understanding of your quick assets, get somewhere inventory and get to know what is current asset and current liability. Liquid ratio, current ratio combination there in a question, it can help you in calculating current asset, current liability, provided you get to the inventory information. For getting inventory information, I have sales, I have gross profit, and I have stock turnover ratio, which is based on COGS. So first working notice or first notice, computation of stock. Once I get stock and I use current ratio and liquid ratio, this will somewhere help me in getting current assets and current liability. So computation of stock. Now what the question has mentioned is sales is 30 lakh, GP margin is 25%. So GP is 25% of sales, hence COGS is 75% of sales. COGS is 75% of sales. So I can indirectly say COGS is equal to 75% into 30 lakh, 22 lakh 50,000, and I can use the formula. Now stock turnover ratio, what's the formula? COGS by, I'll not use the word average stock because I don't have data on average opening and closing, so I'll just use the word stock. Whatever I'm calculating is the closing stock and I'll use it in the balance sheet. So turnover ratio given in the question is 6 times is equal to 2250 by stock, and stock turns out to be 3,75,000. Once I have stock computed, and if you have current ratio and liquid ratio, you can use this combination and get to know what is current asset and current liability. So I have got stock information. So I go to the balance sheet. I'll write current assets, stock in bracket note 1. You'll have to give reference to which note you are calculating this. 3,75,000. Stock is 3,75,000, which is computed in note 1. Note 2 will give me the current assets and current liability. Computation of current assets and current liabilities. I'll somewhere get the current assets and current liability. Now, what I have is current ratio is how much? 1.5 is to 1. So current asset by current liability is 1.5. Current assets is equal to 1.5 CL. Current assets is 1.5 CL. I also have quick ratio. What is the quick ratio given? Liquid ratio or quick ratio, whatever name you want to give, 1, which is quick assets by current liability. Quick assets by current liability is 1. Quick assets is equal to CL. Quick assets is equal to CL. Now what I can say is current assets minus quick assets is equal to 1.5 CL minus 1 CL. Current asset is 1.5 CL, quick asset is 1 CL. Current asset minus quick asset is nothing but inventory. Current assets minus quick assets is nothing but inventory, because quick assets is equal to current assets minus inventory. Ignore prepaid expenses, we don't bring that item. Inventory is equal to 0.5 CL, and CL is equal to, what was the inventory we calculated? 3,75,000 divided by 0.5. Current liability is 7,50,000. Current liability is 7,50,000. Current assets is going to be 7,50,000 into 1.5. 11,25,000. We'll see how we can break it further, but this is the information. Current asset is 11,25,000 and current liability is 7,50,000. If you have current ratio, quick ratio and stock in this combination, it is possible for you to go to current assets, current liability. So technically, if I look at my balance sheet, I know what is the total of current assets. I'll see if I can break it further, and I also know what is the current liability. Next information we have is fixed asset turnover ratio based on COGS. Fixed asset turnover ratio based on COGS. Normally fixed asset turnover ratio is based on sales. Question says it's based on COGS. We'll have to follow that. So my fixed asset turnover ratio is COGS by fixed asset. COGS by fixed asset, which in this case is 1.5, 22,50,000 by fixed assets, and fixed assets will turn out to be 15 lakh. Fixed assets will turn out to be 15 lakh. 22,50,000 divided by 1.5. So we are getting closer to completing this. Fixed assets is 15 lakh. I know the current asset total. Technically, I know the asset side fully now. Unless there is an investment balancing figure, I know the asset side fully as of now. I have used the sales information, I have used the GP ratio, I have used the fixed asset, I have used the stock turnover, liquid ratio, data. Debtors collection period. Debtors collection period is 2 months, which indirectly mean debtors is equal to 2 months of sales. Debtors is equal to 2 months of credit sales. Assumption is normal sales and credit sales all are same. So my debtors is 30 lakh into 2 by 12, 2 months of sales, so which is 5 lakh. We'll see if we can break it further, or I'll more or less leave it at this stage. If further breakage is possible, we'll break it further. Otherwise, because my current asset total was some 11 lakh 25, if we have some other information, we'll see it. As of now, I've used this information. Reserves and surplus to share capital, capital gearing ratio, and fixed assets to net worth. I'll have to use these three. At this stage, what I'm going to do is current liability 7 lakh 50. Current liability is 7 lakh 50. I also closed this cash balancing figure. This is a balancing figure of the current asset. Okay, this is a balancing figure of the current asset. Current asset total was 11 lakh 25. In that, 5 lakh is eliminated, 3 lakh 75 is eliminated. Assumption I don't have anything else. Okay, so I put a total here. So this side should also be 26 lakh 25,000. This side should also be 26 lakh 25,000, which is share capital, reserves and surplus, and fixed capital. What is fixed capital? Is preference and debenture put together. Some data is there to split it. Share capital, reserves and surplus, and fixed capital all put together is 20 balancing figure, which is 18 lakh 75,000. All put together is 18 lakh 75,000. The balancing figure. So there is a ratio there. Capital gearing ratio is 0.5. What is capital gearing ratio is? Fixed capital by equity. Equity means share capital and reserves and surplus put together. Okay. Fixed capital by equity is 0.5. Fixed capital is equal to 0.5 equity. Fixed capital is equal to 0.5 of equity. I don't know the equity as of now. Fixed capital is 0.5 times of the equity. I can also say fixed capital plus equity is equal to 26 lakh 25,000 minus 7 lakh 50. 26 lakh 20,000 minus 7 lakh 50. That balancing figure, asset side total minus the current liability. 0.5 equity plus equity is equal to 18 lakh 75. Can you tell me the equity number? 18 lakh 75 divided by 1.5. 12 lakh. This 12 lakh 50 includes share capital and reserves and surplus. This 12 lakh 50 has share capital and reserves and surplus. I could have calculated this 12 lakh 50 even with this ratio. Okay. Fixed assets to net worth. Fixed assets to net worth also would have given the same. Net worth means share capital and reserves and surplus put together. So at this stage, I can say this is minus 12 lakh 50, which is some 6 lakh 25, minus 12 lakh 50, which is some 6 lakh 25,000. This 12 lakh 50 has to be split further. What they are mentioned is reserves and surplus to the share capital. Reserves and surplus to the share capital is 0.6 is to 1. So what I am going to write here is, this is 0.6, this is 1, this is 1. The ratio is 0.6 is to 1. Or in this calculation, share capital, reserves and surplus 0.6 split 12 lakh 50 in the ratio of 1 is to 0.6. Split 12 lakh 50 in the ratio of 1 is to, see sometimes they can say reserves and surplus to net worth is 0.6. If they use the word to net worth, reserves and surplus is 0.6, share capital is 0.4, balance. Share capital is balance 0.4. Here what they mentioned is reserves and surplus to the share capital. Reserves and surplus to the share capital. So 0.6 is to 1. 0.6 is to 1. Split this 12 lakh 50 in the ratio of 0.6 is to 1 and we are done. So 12 lakh 50 into 0.6 by 1.6 and into 1 by 1.6. We get 781, 250 and 468, 750 and we are kind of done with the balance sheet. So unique or regular adjustment in this question was, one of the common adjustment which will be there in exam question is, one is your current ratio and your quick ratio combination. Current ratio and quick ratio combination is a normal adjustment which will be there in many of the question. Current and quick ratio combination. And second is your capital gearing ratio. capital gearing ratio. Others are self-explanatory. I'm not telling them as an important adjustment. Stock turnover ratio based on COGS is easily understandable. Our fixed asset turnover ratio based on COGS is easily understandable. The critical ratios are, one is liquid ratio and current ratio with stock combination, and the second one is your capital gearing ratio. Go through question 2. Okay, similar requirement. I am required to prepare the balance sheets. I do see that combination again there in the question. Current ratio, quick ratio, and inventory turnover is there, but I don't think so you'll be able to follow the approach which you followed in the previous question. Stock is something which may not be possible to calculate here. So this question, you are going to link this and this item. Working capital, this is another way of using these two ratio. They may give you working capital, which is CA minus CL, current asset minus current liability, and using that and current ratio, you will get current asset and current liability. Using this you will get quick assets, and the gap between them is technically your inventory. So working note 1, computation of current assets, current liability. Note, first let's write the format. Liabilities amount, assets amount. Any question, please write the format first, so that you at least know some of the information could be there in the question. That makes it easier. Share capital 5,75,000. I don't think so anything else is directly available. Share capital 5,75,000, I have written that. Now note 1, computation of current asset and current liability. Current ratio is 1.5 times. Current ratio is 1.5 times. So I can say current asset is equal to 1.5 current liability. Current assets is equal to 1.5 current liability. Then working capital is equal to how much given in the question? This is another combination, like you use the combinations, current ratio, quick ratio, and your stock. This is another combinations. Current assets minus current liability is equal to 1,50,000. 1.5 CL minus CL is equal to 1,50,000. 1.5 current liability minus current liability is equal to 1,50,000. I can say current liability is equal to 3 lakhs. Current assets is equal to 4,50,000. Current liability is 3 lakh, current assets is 1.5 times of 3 lakh, 1.5 times of 3 lakh, which is 4,50,000. Current liability is 0.5 CL is equal to 1,50,000, so you divide by 0.5, you get current liability as 3 lakh. More or less my balance sheet is fitting in place. I know the current asset, I know the current liability. I may want to break it further, so I am writing current assets here. I may want to break it further. I am not writing current liability as a line item because mostly will not break it, so we will directly write that item. We will see if breakage is possible. Current assets as of now I get to know is 4,50,000 and current liability is 3 lakh. Now comes the formula of your quick assets. What is the quick ratio given in the question? Quick assets is equal to 0.8 times of current liability. Quick assets is equal to 0.8 times of current liability. So my quick assets is going to be 2,40,000 and inventory is going to be 4,50,000 minus 2,40,000, 2,10,000. Inventory is going to be 2,10,000. So I go back and write here inventory 2,10,000. You will give reference to whatever note you have used to calculate that. Inventory is 2,10,000. So this is one information which we have calculated. using inventory, if you want, you can calculate COGS. I'm not sure whether there's a need for that, so I'm not getting into the calculation as of now, but I can calculate COGS. You'll have to think about all of this. Using COGS and gross margin, you can calculate sales. Using sales and collection period, you can calculate debtors. So you'll have to think about that much combination. Using your inventory is how much? Sorry, what was the inventory we calculated? 2 lakh. COGS is 5 times of 2 lakh 10. COGS is 5 times of 2 lakh 10, which is 10 lakh 50. COGS is 10 lakh 50. Then next stage, COGS is 75% of sales. Why 75%? Gross margin is 25%. So COGS is 75%. Sales is 10 lakh 50 by 75%. 14 lakh. And my debtors is 14 lakh into 1.5 by 12. Debtors is 14 lakhs into 1.5 by 12. I had the inventory turnover. From there, I got the COGS. From COGS, I got the sales. And from sales, I'm getting to the debtors number. So debtors is 14 lakh into 1.5 by 12. 14 lakh into 1.5 by 12. I don't have any other information, so I'm going to write cash as a balancing figure here. Cash at bank as a balancing figure. This is a balancing figure of the current assets, okay? This is not the balancing figure of the balance sheet. This is a balancing figure of the current assets. Current assets was 4 lakh 50. Current assets was 4 lakh 50. So in that 4 lakh 50, I got this as 65,000. Cash is 65,000. Somewhere there is a relationship between cash and reserves and surplus. There's a relationship between cash and reserves and surplus. They mentioned reserves and surplus to bank and cash is 4 times. So reserves and surplus is 65,000 into 4. 2 lakh 60. 65,000 into 4. I think I've used all ratios now. Now I don't have any other ratio which is pending to be used. We have used data of share capital, working capital is used, gross margin is used, inventory turnover used, average collection period used, current ratio used, quick ratio used, reserves and surplus. The only point I have in the top is current liability comprise bank credit in the ratio of 2:1. Bank credit means short term bank loan. Bank credit is short term loan. So current liability, I'm going to split it as bank credit, others, bank credit and others, 3 lakh into 2 by 3 and 3 lakh into 1 by 3, 2:1. They said bank credit in the ratio of 2:1. So of that 3 lakh of current liability, 2 lakh is bank credit, others is 1 lakh. Now I'm in a stuck situation. I have used all ratios, all information is used. I seem to be ending nowhere because the balance sheet is not completed. I'm just putting a normal total. This side total is 1135, okay? I'm not writing a total, but you'll have to do this in the calculator, 1135. This side total is 4 lakh 50. So somewhere there is a balancing figure which has to come in the asset side. I'm assuming there are no other liabilities. What are no other liability? I'm assuming there's no debenture, no preference capital. I don't have data, so none of them is there in the question. So total of this side is 1135. Total of this side is 4 lakh 50 as of now. My balancing figure is fixed assets. My balancing figure is fixed assets, which is 1135 minus 4 lakh 50, 6 lakh 85. In case the asset side total is higher at this stage itself, then I'll say there is no fixed asset in this company, and balancing figure could have been bank borrowing, long-term loans. Long-term loans could have been a bank borrowing if the asset side total was higher than the liability side, because we have used all ratios. After usage of all ratios, I cannot do much about it. So we have used all ratios, we may have to take some assumption. So this question also the same combination of current ratio, quick ratio, but not with stock. It is with your working capital. It's with the working capital. That combination got used. Any doubts on this? Which one? Which answer you're saying?
Yes, sir. The
Okay, sales is, ठीक है, that's error, 15 lakh into 1 lakh 75 is coming as, no, if you do 15 lakh into 1.5 by 12, or, ठीक है, that's a typing error then, let's not worry. Let's come to question 3. Let's come to question 3. I'll see if there's a need to solve it, or I'll discuss wherever there's a need. I want to just tell you the important combinations from an exam point of view. Okay, broadly similar to the previous question. Stock turnover ratio is there, GP to sales is there. One more ratio which I see, sales to fixed asset. This ratio was not there in the previous question. Average debt collection period, current ratio, liquidity ratio, net working capital. Current, liquidity, net working capital combination can give you current assets, current liability, stock. Using stock and stock turnover ratio, you can go to COGS. Using COGS and GP margin, you can go to sales. Using sales and debt collection period, you can go to debtors. So that's a combination which is there in this question. But apart from that, they have also given data on ratio. Sales to fixed assets is given in the question. So fixed asset can't become a balancing figure. Let's quickly do this. So if you see here, current ratio is 2 times. So current asset is equal to 2 times of current liability. I'm going to do a quick discussion. Some of the items I may not solve also. Current assets is equal to 2 times of current liability. Working capital is current asset minus current liability is 8 lakh. Net 2CL minus CL will be 8 lakh. CL is going to be 8 lakh. CA is going to be 16 lakh. Current assets will be 16 lakh in this question. Current assets is going to be 16 lakh. I'm not going to explain this because this is a normal adjustment. I don't want to spend time there. Current liability is 8 lakh. Quick assets is 1.25. Which is 10 lakh. Stock is 6 lakh. How we got stock of 6 lakh is 16 lakh minus 10 lakh. Stock is 6 lakh. COGS 42 lakh, 7 times. COGS 42 lakh, which is 7 times your inventory turnover ratio. Inventory turnover ratio based on COGS is 7 times. So 6 lakh into 7, 42 lakhs. GP margin is 25% of sale, which means COGS is 75% of sales. COGS is 75% of sales. Can you tell me sales is how much? 42 lakh by 75%. 56 lakhs. And using this 56 lakh, debtors is into 1.5 by 12, which is 7 lakhs, Clear? Any doubts on this? This is an item which I normally do. Normally we solve it. This is what I solved it in the previous question. I want to discuss something beyond that. So if I look at this question at this stage, current assets. In current assets, I have calculated stock, which is 6 lakh, debtors 7 lakh. I'll take cash as a balancing figure, 3 lakh. Cash is the balancing figure, which is 3 lakh. Current liability, I don't have a breakup, 8 lakh. Current liability is 8 lakhs. Then I have a ratio called as sales to fixed asset is 2 times. They have not mentioned fixed asset turnover ratio or anything. They have given, sometimes they may give fixed asset by sales, sometimes they may give sales by fixed asset. If they give something, follow as it is. Let's not get into a formula and all. Sales by fixed asset is 2 times. So sales by FA is 2 times. FA is equal to 56 lakh by 2, 28 lakh. Sales by fixed asset is 2 times. So fixed asset is going to be 56 by 2. So I get fixed asset this side. 28 lakh. Okay. Now we have used stock turnover, we have used GP to sales, we have used sales to fixed asset, debt collection, current ratio, liquid ratio, net working capital. Reserves and surplus to capital is 0.25, and one more good information is long term debt is nil. If you remember, we had a similar scenario in the first question which we did today. In that I said the balancing figure capital employed, share capital plus reserves and surplus plus fixed capital is equal to that balancing figure. In this case they are very clear, long term debt is nil, which means the balancing figure is share capital and reserves and surplus. The balancing figure is share capital and reserves and surplus. The total at this stage is 44 lakhs, 8 lakhs this side. The gap is 36 lakh. The gap is 36 lakh, which is share capital, reserves and surplus. The ratio for them is 0.25. 0.25 by capital. Split 36 lakhs in the ratio of 0.25 is to 1. 36 lakhs, 7 lakh 20 and 28 lakh 80, and this is done. So this was combining some adjustments of question number 1, some adjustments of question 2 that got combined here. Go through question 4. Tell me quickly current assets, current liability. Quickly get the current assets and current liability. Tell me the current asset and current liability figure. 1 lakh 60 and 4 lakhs. So I can break it down further. I'm not getting into that breaking down further. Breaking down further, I think the only breaking down you can do is stock you can calculate, and balancing figure could be other current assets. So the balance sheet may look like this. Current assets is 4 lakhs. Current liability is 1 lakh 60. This is the stage at it is. Now I don't know the fixed assets this side. Okay, fixed asset is missing information. I assume bank overdraft is part of current liability. You can also take it as outside the current liability also. If it's a long-term bank overdraft, it goes under the long-term loan, else it goes under the category of current liability. That's an assumption based. Solution will change based on the assumption. Current asset, current liability, you get it. Now this side I have owner funds. Owner or proprietor funds. Owner or proprietor funds. I don't have anything else is my assumption, okay? Nothing beyond this. I don't want to get into long-term loan. All those items are not there in the question. The only thing you can do is if you want to treat bank overdraft as a long-term loan, that's your wish. Bank overdraft can be taken as a long-term loan. Now listen. Capital employed is equal to, this is one of the formula, okay? Capital employed is equal to current assets, fixed assets plus current assets minus current liability. Fixed assets plus current assets minus current liability. The term capital employed means debt plus equity plus preference, or this is from the liability side. From the asset side, you will say current asset plus current liability current assets plus fixed assets minus the current liability. Either you go from the asset side route or you go from the liability side route. Technically both are same. So capital employed is equal to fixed assets plus current asset minus current liability. This is one part of it. I'll come back to this in a minute. The second thing they have mentioned in the question is fixed assets to proprietor funds is 0.75. Fixed assets to proprietor funds is 0.75. So I can say fixed assets is equal to 0.75 proprietor funds. Fixed assets is equal to 0.75 proprietor funds. Capital employed is equal to proprietor funds. My assumption is there is no other thing. What is capital employed is debt plus equity plus preference. I am assuming there is no debt in the company, there is no preference in the company. So this capital employed is equal to 0.75. Capital employed is equal to proprietor's funds. Alternatively, you can say capital employed is equal to proprietor funds plus bank overdraft of 40,000. If you want to trade bank overdraft as a long-term loan, if you want to take it as long-term loan, see the basic thing is in a balance sheet, capital employed is either these three things together or this. From the asset side, you subtract the current liability. So I am equating both. I have some of the asset side information. This is the previous question, not this question. I have some of the asset side information, some of the liability side information. So what I have done is capital employed is equal to fixed asset plus current asset minus current liability. I am assuming capital employed means only proprietor funds. I am assuming capital employed means only proprietor funds. Fixed asset is 0.75 proprietor funds, and current asset minus current liability. What was the working capital number? 2,40,000. This will give me proprietor funds. 0.25 proprietor funds is equal to 2,40,000. Proprietor funds is equal to 9,60,000. This 9,60,000 has reserves and surplus given in the question, balance is share capital. Reserves and surplus is given in the problem, balance is share capital. Balance is share capital. Proprietary funds, proprietor's funds, they have set fixed assets to somewhere the ratio as mentioned in the question. Fixed assets to proprietary ratio. Fixed assets to proprietary. The normal formula for proprietary ratio is proprietor's funds by fixed assets. That's the normal formula. Here I think they have specifically mentioned take it as fixed assets by proprietor's funds. Fixed assets by proprietor's funds. The normal formula is proprietor funds by fixed assets. So I do this, I get to know this is 0.75. Your proprietor funds is 9,60,000, and this side I will say share capital is 8 lakh, reserves and surplus is 1,60,000, 8 lakh plus 1,60,000 is 9,60,000, fixed asset is 7,20,000, and my balance sheet is over. 7,20,000. How 7,20,000 is 75% of 9,60,000. 75% of 9,60,000. Clear? Any doubts on this? This is with an assumption bank overdraft forms part of current liability. You take an alternate answer, then if bank overdraft forms part of long term debt, then you have to write 40,000 plus proprietor fund is capital employed. 40,000 plus proprietor fund is capital employed. That's a different answer. That's a different assumption, and that will give you a different solution. Go through 5. Go through this question. Okay, this problem wants you to prepare an income statement also indirectly, because they want you to calculate operating expenses, which is a balancing figure in my P&L account, because there are data to calculate P&L information. So I may have to prepare a P&L either in a statement form or in your normal T account form, whatever way you want to do it. But I need to prepare a P&L which will give me the OPEX as the balancing figure, and I need to prepare a balance sheet. Sales is there, return on net worth. Return on net worth is basically profit after tax as a ratio of your shareholders funds, profit after tax, or you can even say EAES, return on net worth. Net worth means shareholders funds. Shareholders funds means share capital and reserves and surplus. If there is a preference dividend also in the company, then EAES is 25% of shareholders funds, else PAT is 25% of shareholders funds. Rate of income tax, share capital to reserves ratio is 7:3. 7:3. Like we had 0.5, 0.6, something like this. This is 7:3. Current ratio is there. Net profit to sales after tax. Net profit to sales after tax. Inventory turnover ratio specific requirement based on COGS and closing stock. They have specifically mentioned this is on closing stock, which is what we normally do. We normally take it as closing stock. Some question may specifically want us to do it on average stock. There will be information there. COGS is there, interest on debentures, trade receivables, trade payable. Let's first prepare an income statement. Income statement. I'll do it in the statement form. Particulars and amount. So we start with sales. We start with sales, which is 600 lakhs. Sales is 600 lakhs less COGS. Sales less COGS. COGS is also given in the question, which is 180 lakhs. I get gross profit. I get gross profit. Gross profit is 420 lakhs. From GP, we subtract operating expenses. Your operating expenses will normally go to your P&L, trading and P&L. There are two components of it. So this goes to the P&L part, less operating expense. You may get EBIT, less interest, EBT, less tax, EAT. Your OPEX can become a balancing figure. Less operating expenses, EBIT, less interest, EBT, less tax, EAT. Somewhere some information is there. What is the EAT number? They have given something on profit after tax. What is profit after tax? They have mentioned something on profit after tax. Profit after tax is 6.25% of sales. So this is into 6.25%. Tax rate given in the question is 40. So this is 100. Tax is 40 and EAT is 60. EAT is 60. So I gross this up and get to the EBT number 62.5. Interest can be calculated. We have interest is given in the question, in fact. 6 lakh. Interest on debentures. Interest on debentures 6 lakh. I get EBIT. And the OPEX is a balancing figure. Should be 351.5 unless there is something else to be considered. My operating expenses is a balancing figure, which is 351.5. Any doubts on this? Next segment is on balance sheet preparation. Any doubts on this OPEX balancing figure? 351.5. Sorry? Interest? No, so they've said interest on debenture is 6 lakh. This at 15% is for a reason. They have not said debentures is 6 lakh. They've said interest on debenture is 6 lakh. At 15% will help you in calculating the amount of debentures. That 15%, if you divide 6 lakh by 15%, you will be able to tell how much is the value of debenture, which is going to help you in your balance sheet side. Okay, let me use some of the ratios quickly. Return on net worth is 25%. Return on net worth is 25%. My earnings after tax is this. By 25%, my net worth should ideally be 150 lakh. Net worth should ideally be 150 lakhs, 37.5 by 25%. I'll prepare the balance sheet in some time. I'm quickly using the ratios. Return on net worth is nothing but PAT by net worth. PAT by net worth is 25. So net worth is equal to PAT by 25%. PAT by 25%. Share capital is 7105 lakh. Reserves is 45 lakh. 7:3. 105 lakh and 45 lakh, that 150 lakhs, 105 and 45. Current ratio, I'll come back to it in some time. Inventory turnover based on COGS and closing stock, based on COGS and closing stock. So I can say closing stock is 180 lakh by 12, which is 15 lakhs. 15 lakhs is my closing stock. I have receivables of 20 lakh, I have payables of 20 lakh. Receivables will go on the asset side, payables will go on the liability side, and debentures is going to be 6 lakh by 15%. Debentures is going to be 6 lakh by 15%, which is 40 lakhs. So if I imagine my P&L balance sheet as of now, I can say share capital is 105, reserves is 45, debentures is 40, trade payables were 20, fixed asset is going to become a balancing figure, stock was 15, receivables was how much? 20. So I'm still not done with the question. I cannot take a balancing figure directly. There is a current ratio given in the question. Current ratio is how much? 2:1. The current ratio is 2 times. Now listen. You can take one of the two assumption, depends on how it will work. For example, let's assume they give receivable as 35. In the question they give receivables as 35. I will assume that current assets include only two items, stock and receivables. I'll assume current assets include only stock and receivable. Why do I make that assumption? You'll understand. Stock and receivable put together is 50 lakh. Your current liability can be half of 50. Current liability can be half of 50. So you can say other current liability and write 5 lakh here. Write 5 lakh here. In case the receivable figure given in the question was 35. Now the receivable figure given in the question is how much? 20. If you say these are the only two current assets, current asset total is 35. Current liability has to be half of which is 17.5, which is not possible because trade payables already sitting as 20. So my assumption is only current liability is trade payable. Only current liability is trade payable, which is 20, which means current assets has to be 40. Current assets has to be 40. So other current asset 5 lakhs. Other current asset 5 lakhs, and then I have a balancing figure which is fixed asset. Balancing figure is going to be fixed assets, which is 170. Balancing figure is fixed asset, which is 170. Any doubts on this? Any doubts on this? Go through question 6. We'll take a break at 1. 1 to 1:45 or 1 to 2 should be the break. I think 1 to 2 would be the break, and the next session would be 2 to 5. Okay, coming to this question, some of the information is given, and good part is the format is also given to us. So we are just required to estimate these items. This is becomes more simpler because once the format is known, you know what is to be calculated. So my shareholders funds is given 6 lakh. Shareholder funds is given in the question, which is 6 lakh. GP is 50. See, your mind should start registering things. GP is 54,000. GP margin is 20%. This should help you in calculating something. What will you calculate? Sales is how much? 2 lakh 70. Your mind should start registering that way. GP is there, GP margin is there, so sales is 2,70,000. Credit sales is 2,16,000. Credit sales is 2,16,000. Total asset turnover is 0.3. Total asset turnover is 0.3, which is sales by total assets is 0.3. So which I can say total assets is equal to sales is 2,70,000 by 0.3, which is, and I'm going to write 9 lakh here as well, 9 lakh this side, because assets total is equal to liabilities total. Assets total is equal to liabilities total. So both side I'm writing 9 lakh rupees. Both the sides we have written 9 lakh rupees. Inventory turnover ratio is 4 times. Inventory turnover ratio is 4 times. You have sales which is 2,70,000. You have GP which is 54,000, which means COGS. COGS is 2,16,000. COGS is 2,16,000, and my ratio is 4 times. My ratio is 4 times, which means inventory is 54,000. Inventory is 54,000. Then debtors is 20 days of credit sales. 20 days of credit sales, not the total sales. Okay, 2,16,000 into 20 by 360. Into 20 by 360. 12,000. Current ratio is 1.8 times, which is your current asset by current liability. Just give me a minute. Okay, I'll come to this. I'll just quickly close this first. Long term debt to equity is how much? 40%, which means my long term debt is 2,40,000, and writing this 9 lakh this side makes a lot of sense now, because this is where it will help you in calculating creditors of 60,000. Else you will get struggle. You will be struggling at this stage because you don't know what to do, because I am not using current ratio as of now, because current ratio is current asset by current liability. Unfortunately, current asset has a cash which I don't know. Current liability has a creditor which also I don't know. So I cannot have two missing information. I cannot have two missing information. If I have one missing information, it's possible for me to proceed ahead. So unfortunately, cash is also not there. Creditors is also not there. So I went to the next ratio. I went to the next ratio, which gave me long term debt as 2,40,000, and this is where copying this 9 lakh this side makes a lot of sense. It helps you in completing the question. When I copied this 9 lakh, creditors become a balancing figure, which is 60,000. Current asset all put together is 1,08,000, 1.8 times, and balancing figure is 7,92,000 of fixed asset. Balancing figure is 7,92,000 of fixed asset. Your current ratio is 1.8 times, which means current assets is going to be 1.8 into 60,000. Clear? Any doubts on this? Again, I am repeating ratios. You need to keep linking items. If you are not linking items, you will struggle. Go through 7. Not much is there in the question for you to estimate. They've given very limited kind of information, so it may become a very short balance sheet. I may not have a lot of information. Now, when I start doing this, equity capital is 1 lakh. I don't know reserves and surplus, so let's not get into that. Total debt to owner's equity is 0.6. Total debt to owner's equity is 0.6, which means overall debt is 60,000. Overall debt is 60,000, which can be split as long-term debt, short-term debt. Short-term debt is 40% of total debt. Short-term debt is 40% of total debt. So this is 24,000, 36,000. Fixed asset is 0.6 of owner's equity, which is 60,000. And now I have total asset turnover and inventory turnover. Those are the only two ratios pending. Those are the only two ratios pending. I have good amount of information on the liability side. Asset side, I have written only fixed asset as of now. I have written only fixed asset till now. I am assuming that these are the only liability and putting a total, which indirectly means there are no creditors, nothing is there in the question. I don't have a choice. I am putting a total of the liability side. It is 1,60,000. I don't have other information in the question, and we cannot calculate also. We cannot calculate. This is also 1,60,000. I can take a balancing figure of current assets and close it, but current assets can be split. I can split the current asset in this question. Now, they have given total asset turnover is 2 times, which means sales is 2 times of 1,60,000. Sales is 2 times of 1,60,000. So, sales is 3,20,000. What is the formula for inventory turnover ratio? Normal formula. COGS by inventory. This question it's sales by inventory. This question it is sales by inventory. Sales is 3,20,000. Inventory is 3,20,000 by 8. 3,20,000 by 8. So inventory is 40,000. Other current asset balancing figure 60,000. Other current asset balancing figure is 60,000. Inventory is 40,000. Other current asset balancing figure is 60,000. Any doubts on this? Go through 8 and try doing it. Go through 8 and try doing it. You try doing it. I want you to solve this. The format is there, so try doing it. More with practice, so I want you to attempt this. Okay, one thing I think I've not properly aligned the question or whatever. The 68,50,000 is the total of creditors and provisions and outstanding expense. Maybe that part is not coming out properly. At least when I read, I didn't understand that. That 68,50,000 is the total of creditors and provisions. Okay, that is not coming out properly in the question. 68,50,000 is the total of creditors and provisions and outstanding expenses. Try doing it. It'll come with practice. That's where I want you to attempt it. That 68 lakh 50 is the total of current liability. First, you will use the formula of current ratio. 68 lakh 50,000 is the total of current liabilities that can give you the current assets, which is 109.6. Then you can get the cash and bank. Then another information which is there in the question is net fixed assets is 20% of total assets. So fixed assets plus current assets is total assets, and that can give you the figure of total assets. So keep doing it. It's with practice. You'll have to keep trying it out. No, they want, no, that's the format they've given. No, they want you to find those two missing information: opening WDV and depreciation. If not, we normally don't get into it. I hope you would have got till this. Then I think there's one adjustment which is a little tricky, so maybe I'll explain it. But I hope you have got till this. Share capital is 25 lakhs. Your net WDV is 27.4. The fixed asset figure is 27.4. Opening WDV, it's like this: 100. Depreciation is 15. So net WDV is 85. So 85 is 27.4. You reverse work and get your opening WDV and depreciation. 27.4 is this: fixed asset plus current asset is equal to total assets. 0.2 total assets plus 109.6. 109.6 was the current asset number, is equal to total assets. Total assets became 137. In that, fixed asset is 27.4 and current asset is 109.4. Current asset is 109.4. Let me know if there's a doubt till this. Anywhere there's a doubt till this. Okay. Now slightly tricky, that's why I'm discussing it. what I can say is stock and debtors put together is stock and debtors put together is some 93.16. Stock and debtors put together is 93.16. I don't know how much is stock, how much is debtors. Somewhere they have given a debtors turnover ratio which is 12 times. They have given a stock turnover ratio which is 16 times. Debtors turnover ratio is 12 times and stock turnover ratio is 16 times. GP margin is also given in the question, but beyond this I don't have anything. GP margin is there in the question, but I don't know the GP number, I don't know the COGS number, I don't know the sales number. So debtors turnover ratio is equal to sales by debtors. So I can say debtors is equal to sales. What was the turnover ratio? How much? 12. Debtors is equal to sales by 12. Debtors is equal to sales by 12. Inventory is equal to COGS by 16. So inventory is equal to 0.8 sales by 16. Inventory is 0.8 sales. Why 0.8 is COGS is 80% of sales. COGS is 80% of sales because the GP margin is given in the question. GP margin is how much? 12%. So indirectly I can say debtor plus inventory is equal to 93 lakh 16,000. 93 lakh 16,000. It's a very good adjustment. So net what happens is sales by 12, 0.8 sales by 16 is equal to 93 lakh 16,000. Solve and get the sales number. Sales by 12 plus 0.8 sales by 16. Sales by 12 plus 0.8 sales by 16 is equal to 93 lakh 16,000. Is equal to 93 lakh 16,000. Sales is your debtors by, debtors is equal to sales by 12 and inventory is equal to 0.8 sales by 12, 0.8 sales by 16. This should be the number, I think. How much? Exactly 498. How much is the sales number you're getting? $698 something. Okay, sorry. 698.70 lakhs. Let me know if there's any calculation error here. Debtors is sales by 12. Inventory is 0.8 sales by 16. 0.8 sales by 16. Just give me a minute. Okay, 698.70, that's right. 698.70 lakhs is the sales figure. Beyond this is a formality. Your debtors is 698.70 divided by, what was the debtors turnover ratio? 12. Your stock is 698.70 into 0.80, 0.80 COGS into 0.80 divided by what ratio? 16 times. So we have got the stock debtors is done. Your creditors is what ratio they have mentioned? Creditors is 10 times and that is based on what? Cost of goods sold. Creditors is based on cost of goods sold. Normally it's based on credit purchases, but they have mentioned creditors ratios on the basis of cost of goods sold. So 698.70 into 0.8 divide by 10, 55.90, 55.90, overall was some 68.50, so this becomes 12.60, overall was some 68.50, some rounding of differences can be there here and there. I've worked with in lakhs, the solution could be in normal numbers, that's not a problem. Creditors is 698.70 into 80%, 80% divide by 10. Any doubts on this? The missing information now is reserves and surplus and 12% long-term debt. Reserves and surplus and 12% long-term debt. I'm not going to do it, I'm going to just quickly discuss it. Can you tell me which ratio will help there? Capital gearing ratio. What is capital gearing ratio going to do is, capital gearing ratio is fixed capital by shareholders funds. Fixed capital by shareholders funds. What I can indirectly say is 137 minus these two numbers. 137 minus these two numbers is the share capital, reserves and surplus and long-term debt put together. Share capital, reserves and surplus, long-term debt put together is 68.50. Capital gearing ratio is equal to fixed capital by shareholders funds. Fixed capital by shareholders funds. So you will somewhere get this 12% long-term debt. What is the capital gearing ratio? 0.6. Just give me a minute. I think this should be the number 25.69 if there is no calculation error. This should be the number. You can apply the formula and get to it. Capital gearing ratio is 25,68,750. So the important part in this question was on the adjustment of stock and debtors. This is something unique. We haven't seen in any other question. This was something unique. That's why I wanted to try it out and then discuss it. Any doubts on this question? Any doubts on this? Because the question did not have data on sales, it did not have data on COGS. So we were struggling to start, because if we have one of these information, we are used to calculating the balance part. Okay. Now this is one type of the question where you are required to prepare a balance sheet. This is in fact more trickier. What we have done till now is more trickier. The second part of the questions is where they'll ask you to calculate some missing data or some ratios. This is easier to do. Getting some items. For example, let's come to this question. Question 9. Following accounting information and financial ratios of M Limited are as under: inventory turnover ratio, creditors turnover ratio, debtors turnover ratio, current ratio, GP ratio, total sales, cash purchases, working capital. Closing inventory is 80,000 more than opening inventory. We are required to calculate average inventory, purchases, average debtors, average creditors, average payment period, average collection period, current asset, current liability. I'll give you maybe 3-4 minutes. I want you to try it. I want you to try and then I discuss. Try it out, we'll discuss. Okay, let's start. Average inventory is COGS by your inventory turnover ratio. The COGS is 75% of sales, so average inventory should be 22 lakh 50 divided by 6 times, which is 3 lakh 75. Purchases is your COGS is nothing but opening stock plus purchase minus closing stock. Opening stock plus purchase minus closing stock. COGS can also include other direct expenses like direct wages and all can be there, but normally this is the formula if there are no wages and other things. Your COGS is 22 lakh 50. Opening stock minus closing stock. They said closing inventory is 80,000 more than opening inventory. So opening stock minus closing stock is minus 80. Opening stock minus closing stock is minus 80. They said closing inventory is 80,000 more than the opening inventory. So the difference is 80,000 but minus because it's opening minus closing plus purchase. So purchase will turn out to be 23 lakh 30,000. Purchase will turn out to be 23 lakh 30. In that cash purchase is 2 lakh 30. Credit purchase will be 21 lakh. Credit purchases is going to be 21 lakh. Cash purchases 2 lakh 30. Total sales is 30 lakh. Cash sales is 25% of credit sales. This does not mean credit sales is 75% of sales. So they have said cash sales is 25% of credit sales. So you'll have to be careful about this. Cash sales plus credit sales is equal to total sales. What is mentioned in the question is cash sales is 25% of credit sale. So 0.25 credit sale plus credit sale is equal to 30 lakh. Hence my credit sale figure is 30 lakh by 1.25, which is 24 lakh. And cash sales is 25% of this. So debtors is equal to 24 lakh by 8. Debtors is equal to 24 lakh by 8, which is 3 lakh. And creditors is equal to credit purchases, which is 21 lakh by 10. 21 lakh by 10. Next is average payment period and average collection period. Average payment, average collection. My average payment period is nothing but 365 by creditors turnover ratio. 365 by creditors turnover ratio. Collection period is 365 by average debtors turnover ratio. 365 by your debtors turnover ratio and 365 by creditors. Payment is how much time you are taking. Collection is how much time you are taking to collect the money from your customers. As of now, my inventory figure, can you tell me what is the inventory figure? How much? 3 lakh 75. Debtor 3 lakh. Creditor 2 lakh 10,000. Now I am required to calculate current assets and current liability. Okay, working capital is also there. You'll use the understanding of working capital and get to your current asset and current liability. CA minus CL is 2 lakh 80 and CA is equal to 2.4 CL. 1.4 current liability is equal to 2 lakh 80. Current liability will turn out to be 2 lakh rupees. Current assets will turn out to be 4 lakh 80,000. Current liability is 2 lakh. Something wrong then. Is the creditor 2 lakh 10?
Yes, sir.
Okay. Technically there is some issue with the question then, because my current liability is turning out to be 2 lakh, which is not possible. The only logic I can give to that is, just give me a minute. The only possibility for that is what you have calculated is average creditor, and maybe the closing creditor is lesser than this number. That's the only thing I can say, because what you calculate in the formula is average creditor, because my current liability is turning out to be 2 lakh in the end. It can't be lower than current your creditors of 2 lakh 10,000. Okay, go through 10. It's a very simple question, but yeah, I've used this question, used this understanding in one of the problem. We have used this in one of the problem. I'm going to use it again. This is a typical 5-mark exam question, or it gets added onto a detailed problem also. Okay, we had done one of the question where this proprietary fixed assets to proprietors fund ratio was there, and we linked it and tried to get the balance sheet. Now listen. Question has said working capital, current asset, fixed assets, current liability, proprietor fund. These are the 4 forms. They have used this word, there is no debt capital. Even if they don't use this word, I have to assume that only there is no debt capital is my assumption, else I will not be in a position to proceed. Current asset minus current liability is 12 lakh, okay. I am writing 12 lakh this side, I am writing 0, okay. Current asset minus current liability is 12 lakh. And then they have said fixed assets to proprietor fund is 0.75. Fixed assets to proprietor fund is 0.75. So my fixed asset is 0.75 proprietor fund. Fixed assets is 0.75 proprietor funds. Capital employed is equal to fixed assets plus current assets minus current liability. This is proprietor funds is equal to 0.75 proprietor fund plus 12 lakhs. 0.75 proprietor fund plus 12 lakhs. You will get to the proprietor funds now. Proprietor funds would be 48 lakhs. Fixed assets would be 36 lakhs. Proprietor funds is 48 lakh. Fixed assets to your proprietor fund ratio. Fixed asset is 48 lakh. Sorry, fixed asset is 36 lakhs and proprietor fund is 48 lakhs. Can you get me this net profit ratio? Think and see. How can you get to net profit ratio? Your fixed asset figure is 36 lakh. Proprietor fund is 48 lakh. Think and tell me how will you get to net profit ratio? What's the formula for your net profit ratio? Net profit by sales into 100. Can you tell me how can you get to net profit here? There's a way to get net profit. There are only limited ratios there. You tell me how will you get net profit? How will you get to the net profit? Which ratio you will use? What is the formula for return on equity? Return on equity formula. Okay, EAS by equity shareholders fund. If there is no preference dividend, EAS is equal to what? Profit after tax. So my net profit is 15% of proprietor funds. Net profit is 15% of proprietor funds. Net profit is 15% of proprietor funds. How can you calculate sales? This you should be able to easily tell. Which formula you will use? Working capital turnover ratio. Working capital turnover ratio is equal to sales by working capital. This is 5 times. So sales is equal to 5 times of working capital, which is 60 lakh. And net profit ratio is 7 lakh 20 by 60 lakh, which is 12%. 7 lakh 20 by 60 lakh, which is 12%. Any doubts on this? Do 11. Do 11. Please do this. It's a quick calculation, there's nothing much to do. The second part may need some calculation. First part is fairly simple. First part is going to be fairly simple, first part of the question. Second part may need some computation at your end. This question, there is some data of average inventory and all, so you'll have to, so there's some opening data, closing data, all that is there, so we'll have to give effect to that as well. How will you get to average inventory? I want participation. How will you get to average inventory? COGS is 85% of sales, which is, my assumption is credit sales is equal to total sales. I don't have data on cash sales in the question. So 85% of 12 lakh 80. Can you tell me what is the average inventory? 2 lakh? In that, closing is only 96, the balance is opening, so I'll have to take the average, but anyway they have not asked me to calculate opening inventory and all. Closing is 96,000. Your average inventory turns out to be 2,72,000. Second, I need average collection period. For average collection period, I have to calculate debtors turnover ratio. Debtors turnover ratio is equal to sales by, I'll have to use average debtors, not debtors. Reason for using average debtor is they've given data on opening debtor. They've given data on opening debtor in the question. If they're not given, I'll not do it, because see, the point is the term average collection period does not mean you'll have to take average. As a general rule, for any ratio where there is a P&L and a balance sheet item, you have to take the average for the balance sheet item, provided you have information on that. I can also directly calculate average collection period. The average collection period formula is average debtor by sale. It's the inverse of that into 360 or 365 depending on the number of days in the year. Now coming to sales, 12 lakh 80. Coming to debtor figure, my current liability is 1 lakh 92. Current assets is 1 lakh 92 into 1.75. Current assets is 1 lakh 92 into 1.75. How much is that? In that 3 lakh 36, closing inventory is 96, cash is 32. Closing inventory is 96, cash is 32, leftover is debtors. How much is debtors? 2 lakh 8,000. Closing is 2 lakh 8, opening is 4 lakh 32, average is how much? 3 lakh. So divide by 3 lakh 20, 4 times, and my average collection period is 360 by 4. 360 by 4, which is 90 days. The average collection period is 360 divided by 4, which is going to be 90 days. Okay, I think we'll take a break and then resume again. Some of the questions I still need to discuss in ratio analysis, so I'll cover that post the break. We'll resume again at 2 o'clock, 1 hour break, and then we resume again.